In 2025, the U.S.-China trade war has erupted with full force under President Trump's second term, pushing tariffs into triple digits and shaking global markets. This video breaks down what tariffs really are, how this year's trade battle has escalated, and how China is hitting back hard. We'll uncover the real impact: skyrocketing prices for consumers, pressure on American farmers, and rising costs for businesses. Are these extreme tariffs delivering results, or dragging the economy into deeper trouble? What is a tariff? A tariff is a tax levied by a government on imported goods or services, aimed at generating revenue or protecting domestic industries by making foreign products costlier. Paid by importers or passed to consumers, tariffs function like a sales tax on imports. For example, a $100 product with a 10% tariff costs $110, with the $10 collected by the government. Tariffs can boost domestic production, but often raise consumer prices and limit choices. In 2025, tariffs have become a central tool in U.S. trade policy, with rates on Chinese goods soaring to 145%, reshaping global trade dynamics. Trump's tariff strategy. The trade war, which began in 2018, saw a dramatic escalation in 2025. On February 4th, Trump imposed a 10% tariff on Chinese imports, citing China's role in fentanyl smuggling. By March 4th, this rose to 20%. In April, tariffs skyrocketed to 145% on most Chinese goods, covering nearly all $440 billion of U.S. imports from China in 2024. These moves, enacted under the International Emergency Economic Powers Act, IEEPA, and Section 301, also targeted steel, aluminum, and autos globally, with a February 1st executive order framing China as a safe haven for opioid trafficking to justify rapid tariff hikes. Trump's 2025 strategy aims to reduce the U.S. trade deficit, revive manufacturing, and pressure China on issues like intellectual property and fentanyl. Unlike 2018, when allies like Canada and the EU were hit hard, 2025 saw temporary exemptions for Canada and Mexico after they pledged cooperation on drug smuggling. However, China remains the focal point, with average U.S. tariffs on Chinese exports now at 124.1%, over 40 times higher than pre-2018 levels. Trump has also proposed tariffs as high as 145% to fund tax cuts and replace income taxes, though economists call this mathematically infeasible. The administration has shown inconsistency, exempting products like smartphones, laptops, and semiconductors, only to later reverse some exemptions. This unpredictability has fueled market volatility and supply chain disruptions, with retailers like Walmart and Target warning of empty shelves by mid-2025. Trump's rhetoric suggests tariffs may come down substantially, but not to zero. Yet no formal negotiations have been confirmed, despite his claims of talks with China. China's response. China has matched U.S. aggression with retaliatory tariffs, raising duties on U.S. goods to 125% by April 10, 2025, covering all $145 billion of U.S. exports to China in 2024. Initial retaliation in February targeted coal, liquefied natural gas, oil, and agricultural machinery with 10–15% tariffs. By March, China imposed 10–15% duties on U.S. agricultural, meat, and dairy products. China also added U.S. firms like PVH Corporation and Illumina to its unreliable entity list, launched an antitrust probe into Google, and imposed export controls on metals like tungsten and rare earth minerals critical for semiconductors. Agriculture, a key U.S. export sector, has been hit hardest. Soybean exports, valued at $15 billion in 2023, plummeted in April 2025, with canceled orders and layoffs reported by farmers. A Washington hay exporter, for instance, lost 25% of its workforce after rerouting shipments from China to Japan, and Dubai proved unsustainable. China's tariffs have also disrupted energy exports, with $15 billion in U.S. oil, gas, and coal at risk. To counter U.S. chip restrictions, China banned exports of key semiconductor components, escalating the tech rivalry. China's leadership, under Xi Jinping, has signaled resilience, with state media declaring no winner in a tariff war. Economic impact. The 2025 trade war has unleashed significant economic consequences, with costs outweighing benefits for most Americans. Key impacts include farmers and exporters. U.S. agriculture is in a full-blown crisis, with exports to China collapsing. The Port of Oakland, a major export hub, reports a 29% drop in trade volume due to Chinese tariffs on almonds, beef, pork, and dairy. USDA data shows soybean exports fell sharply in April 2025, costing farmers billions. Consumers. Tariffs have raised costs for U.S. households by an estimated $1,300 in 2025. Prices for electronics, toys, and appliances, 95% of which come from China, have surged. For example, child safety seats and cooking appliances, nearly all imported from China, face doubled prices or shortages. The IMF raised its 2025 U.S. inflation forecast to 3%, driven by tariffs, while retail giants warn of empty shelves by Christmas 2025. Manufacturers. Protected sectors like steel and aluminum saw modest gains, but downstream industries, autos, appliances, and clean energy face higher input costs. The 25% global tariffs on steel and aluminum have strained U.S. EV manufacturers, who rely on Chinese lithium-ion batteries, 70% of U.S. supply in 2024. Exemptions for battery metals like lithium are under review, but uncertainty hampers investment. The CHIPS Act, meant to boost domestic semiconductor production, faces criticism from Trump, risking further delays. Economy and markets. The U.S. economy contracted by 0.3% in Q1 2025, the first downturn in 3 years, while China grew at 5.4%. Imports fell by $740 billion, 22%, and the S&P 500 lost over $6 trillion. Economists estimate an 8% GDP drop and 7% wage decline if tariffs persist. Global trade volume dipped 0.2%, and supply chains are buckling, with 35–42% of Asia-US shipping canceled in April–May 2025. The IMF warns of a potential U.S. recession, with J.P. Morgan forecasting negative growth in late 2025. Revenue. Tariffs are projected to raise $1.2 trillion over a decade, but this acts as a tax hike on Americans. The Tax Foundation notes that tariff revenue cannot replace income taxes, as Trump suggested, due to insufficient scale and import reductions. China's 125% tariffs, covering all U.S. exports, yield less revenue due to lower trade volumes. Did it work? Trump's tariffs aim to shrink the trade deficit, boost manufacturing, and force Chinese concessions. The 2025 results are largely negative. Trade deficit. The U.S. goods trade deficit with China, $295 billion in 2024, has not narrowed significantly. Bilateral trade, valued at $585 billion in 2024, is projected to shrink by 80% over 2 years, with direct trade collapsing. China has redirected exports to the EU, Mexico, and Vietnam, increasing its global trade share by 4% since 2016, while the U.S. share dips. The Phase 1 deal's $200 billion target, unmet in 2020, remains unfulfilled, with no new agreement in sight. Jobs and industry. Steel and aluminum jobs saw marginal gains, but agriculture and retail face massive losses. Goldman Sachs estimates 10 to 20 million Chinese jobs and millions of U.S. jobs in export, wholesale, and retail are at risk. The toy and hobby sector, supporting 400,000 to 600,000 U.S. jobs, faces shortages and price hikes. Manufacturing investment has stalled due to policy uncertainty, with no significant reshoring. Bargaining leverage. No major trade deal has emerged. China's refusal to negotiate unless tariffs are lifted has stalled progress. The Phase 1 agreements superfluous. Modest IP and currency pledges are outdated, and 2025 exemptions for semiconductors and pharmaceuticals suggest both sides are mitigating damage rather than resolving disputes. Economists at the Peterson Institute argue the tariffs have primarily burdened Americans with higher costs and economic slowdown. The 2025 U.S.-China trade war has disrupted global trade, spiked consumer prices, and crippled U.S. agriculture, with little progress on deficits or manufacturing. Supporters argue tariffs signal strength. Critics, including the IMF and Goldman Sachs, warn of recession risks and global supply chain chaos. As both nations dig in, the question remains, can tariffs achieve their goals, or are they a self-inflicted wound? For now, the evidence points to pain over progress.